Hello and welcome to this very special webinar, and we'll be focusing on fixed income category and explaining you everything about how can you invest in a long duration fund. And the reason why we are doing this is because with the recent economic developments and evolving market dynamics, understanding the nuances of fixed income investment has become more important than ever. As interest rates fluctuate and global economies face uncertainties, navigating the debt market can be challenging. Now, to provide you with valuable insights and help you make informed investment decisions, we are excited to host this webinar where we will be talking about should we consider a long duration fund in this current market scenario. Now, for this, joining us today for a very special discussion is Kruti, Chheta, fund manager and fixed income analyst at Mirae Asset Investment Managers India. Kruti, thank you so much for joining in and welcome to this very special webinar today.
Thank you for having me.
And for our viewers, before I start the conversation, just a request, you can also ask your questions to Kruti. All you have to do is just send across your question and we will try and accommodate as many as we can. All right, Kruti, so let's begin. And this is going to be a webinar not only about long duration fund, but then also let's focus on the entire debt scenario that's emerging in India and abroad. Let me start with taking the cue from abroad. Now, post Trump's victory, a lot of changes in the global politics and economy that we've been witnessing. Specifically talking about the debt market, how do you think this US mandate will actually impact, looking at Trump's focus on reducing taxes and increasing trade tariffs, which will also create sort of an inflationary environment, because so far the policies are sounding pro-economy and pro-growth, which obviously all the time leads to higher inflationary environment. How do you look at it? So far from the Fed, we have seen a 75 BPS cut. How do you analyze the data that's coming over there, the new US mandate, and its impact on the yields over there?
So, Kavita, there are two ways of looking at it, and the first one is where the market has front run and it has, priced in the worst, saying that there is going to be inflationary pressure because there is going to be trade tariffs, there is going to be tariff wars that are going to come in the coming times, and there could be economies which could be clashing with each other. Another aspect to look at it is that, Trump has also now gotten a separate department to improve the government efficiency. And if you see the first headlines that is coming in, that we need to cut on the government expenditure, we need to increase the government efficiency. 2 trillion is something that they're already looking at cutting down the expenditure from the government. And to just speak more on the tariffs, right now there has been a very singular way that there could be more tariffs on China, probably starting off with, and then there could be some which could be more of minor ones. It could be more of a negotiating deal on the table rather than going after the economies, because as of now what we are seeing is that the tariff game that is going to be there, that is going to be more to bring it on the negotiations, to bring on the table and bring some of the manufacturing to US rather than being concentrated on China. So the market has been a typical buy on rumors and sell on the news. So a lot of front running has already happened. We will only see when the office is assumed and actually policies come in place, how the markets are playing it out, whether it will be inflationary, because at the same time he's talking about cutting the jobs also. If the jobs are getting cut, then there is going to be repercussions of that. We are talking about fiscal widening, but he's talking about the expenses coming down. So there is one aspect that the market has looked at, the other is yet to play it out. There could be some pressures, but we feel that in a longer run it's going to balance it out rather than prove more negative for the debt markets or negative for the global. And one of the agendas which Trump went in with it was stop war, and that has been on top of it, that stop Ukraine war. So if that is coming to a peace, we will see less of the volatility in the commodity markets, we will see less volatility in and around the countries that are supporting it. So there could be, obviously because of the tariffs, some fluctuations and some volatility which might be coming in, but there are some of the pros also which are there, which are not yet being the market narrative and overall. So classic again, that there is lot of assumptions that is happening, and only when the things get in action we will see that, you know, how the entire narrative plays out as of now.
All right. Since you mentioned the initial volatility, I want to understand the movement of yields in this scenario.
So, if you see over the last 1 year, the US Treasuries have been extremely volatile. Being on a developed market, we've seen a volatility of a 10 basis on an everyday basis, which is very high for a developed market like that, because usually you see a 2 or a 5 basis points on an event day. So there has been lot of volatility in terms of the US market itself, because the developments are happening in and around the market, and there are a lot of assumptions that are running in the market. So we also saw US Treasuries going up to 5% last year. From there we've seen drop it to 3.8, and just after the election we've seen that that 3.8 has now reached to 4.4%. So the narrative that is there, that, you know, the developed markets are less volatile, no, now it's become more investor driven rather than being, you know, a characteristic of a developed market, that it would be fairly stable rather than being less volatile, or the opportunities are not there.
So what triggers would you attribute from this 3.8 to 4.5% rise?
On face of it right now, it's the primarily election and the market's expectations that there is going to be inflation in the market. Then there could be a possible pause from the Fed going ahead if the inflation continues, or there is any initial, you know, sign of inflation going higher from here, or if there is going to be more tariffs, which is not only going to be unilateral, but they're going to be bilateral and across the countries, then obviously the imports become more expensive, and US primarily is not ready right now to manufacture by itself. And the third, if there are going to be more spending power in the hand of the consumers, where we are talking more of a pro-business US, then there is going to be more spending power, which could again lead to an inflation. So these all expectations of the market are leading the yields to go higher at the current stage, rather than, like, you know, the actual action happening on the ground level. If you see the actual action happening, we are talking about job cuts. We are talking about Musk, who is primarily leading the committee who fired 80% of the workforce when he took over X. So there is a lot to play out, and right now a lot of assumptions are just playing out. So we'll have to see only when the officers assume and the cabinets are taken over, that how the entire...
What according to you is going to be on radar for the Fed? We've already seen a 75 BPS cut. Do you think, considering all of these things, a Fed chairperson would be open for further rate cuts, although they have said in numerous statements that, you know, it's all data driven and we'll have to see how the policies come out and roll out, but inflation is going to be high on their radar?
See, if a central bank is an independent body, whether whatever the regime is, the regime change should not change the outlook how a central bank is looking at it. And what are the three primary concerns of Fed at this point of time, or any central bank should be? Employment, unemployment primarily, your growth, and how your GDP growth and your inflation. For last 2 years, we've seen inflation playing out. We have seen from 2% to 9% to 5% stabilizing, and now we've seen that subpar it's gone below 3% primarily. Now it's settling down at 2.5%, around 2.6%. So inflation right now seems to be that it is stabilized, but it is not at the target level that where it should be. 2% is their target initially, but it's not an uncomfortable level for them. Second is your growth. US is the only economy which has been upgraded on the growth front for this year. So we are not seeing that the growth is somewhere on the backside, or, you know, it is not growing in direction. And given that the new regime is coming up, there is more pro growth, and we are seeing that will be in a directional level. Now the third one becomes a tricky one, the unemployment one. Unemployment at a 4% plus is one of the highest in history after the volatility that they've seen during the depression and everything. And we've seen a 4% that has been parked for now almost 2 quarters. It stayed there.
Yeah, it stayed there.
With the new regime, we are expecting that this number might go higher. which we were expecting that probably at the end of next year this would be around 3.9 or so on, but we are seeing that this number might go higher. Now if the unemployment is going higher and your inflation is in a comfortable level, then Fed would likely want to go on for a rate cut, because if you see a dot plot, whether you see a last year's dot plot or you see a this year's dot plot, the interim changes for the dot plot, that is that the path changes. There could be front loaded rate cuts, or there could be rate cuts which could be in a moderation, but by the end of 2025, whether you pick up last year or this year, both of them show that they want to be in the range of 3.25 is somewhere the range. Most of the members are seeing that. So yes, the path is clear. There could be volatility in the path where there could be a front loading, or there could be certain small rate cuts, but the final target is pretty much set in their head, that where they want to be at the end of
That's a comfortable band. Sure.
Yeah.
Let's talk about the Indian context now, and let's talk about RBI, where again inflation has been seen coming up due to food prices. That's always been a concern, I think, during this particular part of the year, where we've seen inflation going up. But it's well above RBI's comfortable zone, okay? And but now, looking at how Trump is expected to mellow down the geopolitical tensions, we will see commodity prices cooling off. So that's going to be a huge relief for the entire world. But from the India's context, India's point of view, and with inflation rising up again, are we ready for a rate cut, or we should be pausing? What are the factors, according to you, that will be considered by RBI?
So for RBI, in addition to inflation and growth, the third factor is the currency volatility, which they would want to look at primarily when they are taking the decision. But if you ask me, India as an economy, against the global development that has happened, we have shown a beautiful resilience. Yes, and we totally have set a stage. From here on, we are ready to take the next leap, and for
one of the expensive markets in the world.
So for example, when the US election day, when the elections were announced and US Treasury almost went to 4.5 again, the expectation was that the India 10-year GSEC would also see a drop in the prices. To market surprise, India GSEC actually closed better. So the kind of resilience that Indian GSEC market is showing right now, it pretty much goes with the narrative where the governor says that now we do need to look at the global, but domestically also now we are in a state where we take decisions according to what the domestic developments are happening, without getting too much hampered about the globalism. Obviously everything works in a sync, but today the situation globally has become that every economy is diversified and is taking its own decision, rather than following one path of Fed will do something and we'll follow the path. And many of such economies are there which went for a rate cut before Fed even started talking about it. Some have gone on a pause right now, like for Australia right now it's gone on a pause. India went for a neutral, but we've not gone in for a rate cut right now. Having said that, are we set? Yes, we are set, but we will wait it out till we see a stabilization rather than we want to be preemptive, we don't want to be reactive, but that preemptive should be with a set path rather than taking a pause and then again seeing developments as well. Our governor is very preemptive.
All right. So here we've set the narrative and helped our viewers who are watching us live understand the entire functioning of the debt market and the kind of triggers it's affected by. Now let's talk about long duration debt funds, okay? And a lot of questions are also coming in where Namrata, our viewer, is asking that any particular age group that should be investing in this particular category. But before I get on to that question, it's very important to ask Kruti about what exactly is this category. You're talking about long duration debt funds. Now, before the rate cut scenario, there was a lot of conversation about, parking your money in long term and making the most of the time available at that point in time. But then now how the scenario has changed globally and even in India, do we still have time to park in money in long duration debt funds? What is this category? How does it work?
So, since you've asked me this question that, people, parked it before and is this right time?
Yeah.
To that question, I would ask that, are we not seeing rate cuts coming?
Huh.
So, if we are seeing rate cuts coming, then this is still an appropriate time to park your money in a duration kind of a product. Now, moving on to a long duration category.
When we say duration, what exactly do we mean?
So when we say duration, it is typically like a corporate bond which is there, or let's say that I am taking a loan, for example, right? A car loan probably. So I'm taking a loan for a 4 year, right? So that is the duration of my loan that is there. It is for
Your loan
4
tenure,
years.
yeah.
That is for 4 years. Now in that 4 years, if I'm expecting that interest rates are going to go higher, then I'd probably want to lock in at a lower yield because I want to pay less.
Exactly.
But a banker who is expecting that the interest rate is going to go down will try to sell you a
higher interest rate.
fluctuating loan, so that as the interest rate goes up, your interest cost also goes up and the bank, benefits out of it.
Sure.
So similarly, think of it as that when you are buying into a duration and you are expecting that the interest rates are going to come down from here, you are essentially locking in at a higher interest rate, so
Sure.
that you benefit out of that higher interest rate when the interest rate eventually comes down.
Okay.
So we can get more into it of how the accrual plays out and the power of compounding
Sure.
can help you.
Yeah.
But essentially it is that you lock it at higher and you get that interest rate every year, that high coupon is there. So supposedly in say a tenure of a 5 year, you are expecting that the current 7% goes down to a 5%. You are still receiving a 7% compared to an investor who is invested today at 5%, right? So that is your gain that you will have over the period of time.
Okay, so ideally, what's the duration of long duration debt funds available right now?
So the long duration category as such, the minimum duration allowed is 7.
Okay.
Is 7, and the highest that it can go is 12. So when we say 7 is a modified duration. A 15-year paper would be somewhere at a modified duration of 7, and when we say 7, it is an interest rate risk that is there. So you can term it as a risk. When we say a 12-year, that would typically be a tenure of let's say 30 years or 25 to 30 year band of the papers which would be there. So that interest rate risk comes to 12. Modified duration.
Talking about the interest rate risk now, because we're talking about a 7-year duration, a 12-year duration, and you've put in money for that long, there will be variation in interest rate.
Right.
So is it important to stay put till that particular time? Because if you come out of it, you might be having an interest rate risk at that time.
So it depends that what is investor looking at, okay? If an investor is mature and investor is looking for a stable income, then you stay put and you do not get, impacted by the volatility in the market, because then eventually you are looking at that the interest rates are going to go lower.
Okay.
That is what we are looking at. But if
So
you
like for example, if someone is locking in money now,
right,
okay, and looking at the scenario, we might be for a longer term, maybe a 7-year or 12-year. Should this be an apt time for them to lock in for that particular period? Because we will be seeing fluctuation, if at all the scenario of rate cut goes aggressive in India also, there will be fluctuation in their performance of the fund?
There will be fluctuations, but let me just put in another angle to it.
Sure.
Right now we are seeing India as a structural story.
Okay.
And we are seeing that the India interest rates are now ready to move to a lower notch than what they are. We have come a long way from 2000s, where we've seen interest rates at 12% to now 6.5%. And we've gradually seen that coming to 8%, 7.5% and now 6.5%. So there will be an volatility, but what we are trying to say over here is that because before there was no inflation targeting, now we have inflation targeting which is in focus. Now we have CAD. You spoke about the commodity volatility that will come down, but even after a war of 2 years, we have not seen CAD surpassing our previous levels. We have managed it beautifully. We are very cautious about how fiscally we are spending. We are going more towards capex, where the revenue can come back rather than revenue expenditure. The stage is set for the next, lower interest rate to go. But there will be an interim volatility, but what we're trying to say essentially is that where there was a scope of volatility being very wide, now it has narrowed down.
Okay.
So as an investor, if you have a target that you are going to not utilize, or you need this money for your future purposes, for the stability of income, you should not be bothered by the interim volatility. But if you are an active investor and you do track this market closely, then you can always take an in and out of call of it and make the most out of the volatility of the market.
Sure. I want to really ask you a question where we will do a slight comparison between traditional fixed income products and long duration debt funds. But before that, you might want to answer Namrata's question on what is the right age to invest in long duration funds.
There is no age of investment. You can always invest at any age. It is only your knowledge about the market that what asset you want to get into. But from a fixed income perspective, the typical allocation says 60-40. Like,
the portfolio allocation.
The asset allocation says 60-40. But obviously it varies from an investor's risk appetite, and it varies from the age that you are there. For a long duration fund, probably a little more matured audience or a aware audience would be more appropriate for this, because if you want to play an interest rate investment, then you have to be very aware of this market, that where the interest rates are going. You need to be very on hands with what globally economy is happening, what domestic is happening. But if you are if you're not an active investor and you're not tracking this market closely, then probably the age group that fits in is for the matured age, where you are seeing at a point of time where you want to preserve your wealth rather than take risk with it and see the volatility through it. This provides a stability to your portfolio, and probably in needs where there could be volatility in the other markets and you cannot look at redeeming that. These are the safer options to redeem rather than looking at your wealth creation.
Sure. So more than the age, I think, Namrata, it's more about your risk profile. If you are conservative and if you are not ready to take a lot of risk, then maybe you can park in your money in such kind of a fixed income products. But why should one consider a long duration fund and not a traditional fixed income option that's available to them? A slight comparison on the basis of risk, on the basis of security, on the basis of taxation, if you could explain, because these are the basic criteria where an investor would want to consider any fixed income product, be it a fixed deposit or a debt fund. And here, since we all know that India loves fixed deposit a lot when it comes to fixed income category, and we are trying to help you understand a specific category in debt fund, which is a long duration fund. So if I want to compare long duration fund with other aspects of traditional fixed income instruments, what should be your parameters, your criteria of investments also?
So I'll just go by the easy comparison of the two categories. A and foremost, your mutual funds. I know the indexation has been removed, but indexation removal has not taken the benefits from the investment. It was an added benefit which was there, but now all the asset classes are at the par. There is a direct comparison to all the instruments that are there. So if you speak from the liquidity perspective, mutual funds offer easy liquidity. There is no question asked whenever you redeem. There is no penalty for exiting at any point of time.
Even before the actual tenure.
Yes, you can exit.
So if one is invested for 7 years, if they want the money in 3 years' time,
they can do it.
There'll be an interest rate loss.
If the market is volatile and if there is interest rate movement that has happened negative, then probably yes. But an investor would be that much aware that because there is a publication of NAV every day, you can see your returns every day, an investor would know that where they stand.
Sure.
But otherwise, yes, if you're locking in for 1 year, or even if you are investing for 2 months, you're free to take your money whenever you want. So liquidity is easily available with these instruments.
Sure.
Second is that when we talk of taxation, you get taxed at your redemption. not anywhere in between, which
Sure.
is not the case with the traditional investments. And when you get taxed in interim, even before getting money in hand, that is something that you are losing. That is the power of compounding. Right. So if for example, if I am holding a mutual fund, and if I am holding it for a good 10 years, let's say 7% is the coupon, I don't get taxed in between, because my taxation is at the end of the year. I'm not paying my personal tax at the end of the year. I'm paying it only when I redeem it. So that gives me the benefit that I get to reinvest that coupon at the similar or the market levels which is there, without paying the tax of whatever 30% is there, which is not the case with the traditional assets where you get taxed quarterly. So if you see over the period of time, if you are a long-term investor, that hits your portfolio by around 80 basis to 1% on because of losing of accrual and because of the taxation. So that 1% over a long period of time, and something that you are seeing as a stable part of the portfolio, is a lot of cost to give versus. And the third is that you are always at the risk of the reinvestment. So every year there could be good times also, there could be bad times also. But if you are seeing that the regime is moving, and you are aiming towards a lower interest rate environment, then you would see that every year you are getting that much less interest rate, and you have to reinvest every year. So that is another loss that probably you will be making by not locking in into a long duration product.
Okay. We have more points to discuss, but then before that, let's take our viewers' question, Vivek's question. We've already covered this point, but then I think let's just explain this to Vivek. He wants to know about the risk involved. Since it doesn't debt category instruments, they don't invest in equities. What's the volatility that we are talking about, and what's the interest rate risk that we are talking about, if there are any risk involved from an investor's point of view, if one needs to know?
So when you are investing in a category like a debt, there are two risks that is involved in this. That is interest rate risk and credit risk. That is
any debt category. There are 16 debt categories.
No, not any debt category.
Okay.
So if you go something like a long duration fund, there is no credit risk that is involved. You can always refer to a PRC matrix before investing. That
what is a PRC matrix?
PRC matrix is essentially, with every category there is a matrix which is given, which tells you the interest rate risk and the credit risk of the portfolio.
Okay.
So generally for a long term fund, there would be interest rate risk, but there won't be credit risk that would be involved. But for a shorter tenure debt like categories, there could be that they are in a B1 or a B2 category.
So investors get this information while investing. I mean, they have it on the scheme documents?
Yes, they have it on their scheme documents.
So they know where the fund is investing?
They know where the fund is. We have the portfolios out every fortnightly, which comes in the mail to people. And even on the fact sheet, with every fund, the first thing that you would see that the riskometer and the PRC matrix will be there. So the investor is well aware of what he or she is investing into.
Oh, that's great. That's great.
So one is that you can always refer to that. So speaking of the risk involved with investing in debt, these are the two primary risks that are involved. So interest rate risk and credit risk. Credit risk is not there in this category. We are talking about interest rate risk. But what we are essentially talking about interest rate over here is that we are betting on an India story.
Right.
And if you believe that there is going to be an India story, if you believe that there are going to be interest rates that are going to go down from here on, or we are just at the edge of an interest rate cut cycle, then an investor should consider this product in their portfolio.
Okay, so since you mentioned the portfolio of a debt fund, so when we talk about a typical long duration fund, what's the kind of a portfolio that we're talking about across that is available? More towards corporate bonds or government bonds, or do we have a mix of that also that investors can invest into?
So because we are talking about a long duration fund and the minimum tenure that is to be maintained as 7 years, your portfolio is largely made up of sovereign debt, that is the GSEC, and then there could be some of the SDLs, and they're very minimal part of corporate bonds, because corporate bonds don't issue typically for that longer period. So very less of corporate bond, but this category in itself is meant to take an interest rate call rather than go for any accrual or a credit. primarily plays on what the economy's expectations are on the interest rate for the country.
Let's talk about the NFO that's open, long duration fund NFO of Mirae Asset. Give us the details. When is it closing?
It's closing on 2nd of December. We launched this NFO at a sweet time when we are already at the edge of expectation of interest rate, and very interesting times because global markets have also become very volatile. So it gives an investor a good time to get in at this point of time and make most out of it.
All right, so that's an opportunity for all the investors out there, and for our live viewers, let's also include them now, Kruti, and a lot of questions coming up for you. I will take Puja's question now, and Puja says that what goal of an investor would be fulfilled through a long duration fund, especially if someone wants to know from a wealth creation point of view. I know we've covered this point earlier also, but then let's go in depth, because Puja's question is also a lot in terms of your portfolio creation. It is very important to have debt in your portfolio. The allocation ratio can change as per your age, it can change as per your risk appetite, but primarily what kind of goals can we line up with a debt investment?
So primarily the object of a debt, let me take it this way, okay? Today we have so many investors that are there, right? And if you go, essentially, India loves fixed deposits.
Totally.
I mean, we've seen last 1 week, the moment the market shakes off, the reallocation happens to fixed deposits and your deposits grow. So the whole idea about going to a fixed deposit is that you want a stability.
Yeah.
And you know that you want to, preserve your wealth rather than losing it to the volatility
can't take
of
risk
the market.
on your money. Yeah.
So similarly, your mutual fund, debt mutual funds offer you a same agenda or for your portfolio, but just in a more efficient way, just in more transparent way, where investors know that where they are investing in and they have an easy in and out. So if you ask me that why investors should have a debt in their portfolio, is it an alternative to another asset class? There's no alternative to another asset class, but you have to understand that you have to have this in your portfolio for stability of your portfolio. You need to have this because if you are removing from one asset class, you're likely to put it in another asset class. Can this be considered? Yes. And when we say that, what goal it is creating, so let me just give an example. We spoke about a long duration fund, but in general also, COVID was the time when we saw that the markets went down. We saw that there were a lot of hospital bills and everything that were coming, which probably many people would not have insurance also, but those people would be invested in equities or other. At that point of time, when their wealth is deteriorated in the equity markets, what could have possibly served them better is having a debt in their portfolio, because they could have easily liquidated without letting go that. So it helps when we say that debt should be there in the portfolio and it helps you stabilizing, is that when the times are bad for other classes, you don't want to touch your wealth creation asset. You want something in interim which helps you, and that interim can be a vacation that you want to take, a hospitalization bill that is there, or it could be your holiday that you want to take, but for that reason you need to have this
money.
You cannot depend on market volatility for that, right? So for any age class, depending on the risk appetite, there should be that stability in your portfolio.
Sure. So that was Puja's answer. But then let me just come back to the question on the NFO. Now you're also handling the Mirae Asset Long Duration Fund. I just want to know about your investment strategies, or I don't know if it's too early to ask you this question, but then primarily what is it that you are going to take care of?
So, long duration as a category, we've seen that the minimum duration that is allowed is 7 years. So, obviously, it is going to invest in a longer tenure papers, and the longer tenure papers currently are your primarily G-Secs, which is there. So, this is going to be a heavy G-Sec portfolio, and probably a small portion of it in corporate bond. And since we are positive on the interest rate and we are at the edge of an interest rate cut cycle, probably if not 3 months, maybe in like a 5 month, we will see that coming through. So we are we want to keep the interest rate at the highest possible this category would allow, so that an investor can reap most of the interest rate cycle cut.
So far, how would you like to help our viewers understand the trajectory of government bond yields? Talking about the recent developments also, how's the moment been?
The moment, surprisingly, when we started the conversation, that compared to the global developments, there has been a very minuscule volatility. So where we've seen that the global yields have fluctuated, US Treasuries have fluctuated 10 basis every day, we have not seen a 5 basis movement also on an event. So that's the kind of resilience that we are showing right now as an Indian market, and it shows that the maturity of the market has come, where investors are being more reactive or more prone to the domestic developments rather than getting affected with the global developments.
Sure. So if you're investing, so for example, Mirae Asset Long Duration Fund, if we take this fund under consideration, which is very GSEC heavy, we are also betting on the India growth story. Can we say that?
Yes, we are only betting on India growth story from here on. A few reasons for that. If we see the structural spending pattern of the people has also changed. So we've moved from India buying a hatchback, or when we had long time, the cars were not of a thing, but now people are not buying hatchbacks, they are buying SUVs. The personal credit has gone up, and for any country to break out of the cycle, the personal credit is the first thing that comes in, where people start spending on things like mobile phones, cars, or any other things. And we've seen in general the pattern of the India spending has changed. So yes, we are seeing that we are moving towards that mark where I wouldn't say upper middle class, but a middle class is something that we are aiming at. And everyone, because there is a social media and there is a mobile phone in a hand, everyone is becoming ambitious now. Everyone wants things that are seen on the social media. So definitely a consumption story, a growth story, and demography is favorable to us. So hopefully from here, India is on a path of top 3 of the economies in next 5 years.
Talking about investing in debt funds, and especially a debt fund that is longer duration in nature, what should be the mode of investment ideally? Should one be going for a lump sum investment or SIP as a concept in debt funds?
That really depends on what kind of investor you are. If you are an active investor or someone who is at a mature phase where has a surplus year and wants to do income removal for their retirement, then they
like
should
an SWP.
An SWP. Then one should go for a lump sum at this point of time. But if someone is creating a corpus for not near but a far future, then they can go for a SIP mode rather than going for a lump sum right now, so that they can reap the benefit of the volatility, the interim volatility in the market.
So now explain me the concept of SIP in a debt fund. Now when we do an SIP in equity fund, we get the NAV of that particular day, which eventually averages out and then you get the return, etc. How do we understand this for a debt fund?
So for SIP for a debt fund is similar. If you are investing today at, let's say, my GSEC is at 6.9 and you are investing today at 6.9, your NAV gets locked in at 6.9. So if you are in, let's say, 1 year, if your interest rate is going to 6.4 or your yield is going to 6.4 and you decide to redeem it, 6.4 is something that you are going to redeem at. So it works similarly as your equity, where you average it out. So suppose, let's say that tomorrow something goes wrong, or we decide that there is going to be a higher interest rate, or from 6.9 we've gone to a 7%. As an investor, you would want to reap the benefit of that also. So SIP helps you capturing the market movements at various levels, similar to equity.
All right. Okay, so we have a question for your NFO also that's coming up from Ashish. Ashish is asking, what is the benchmark for this particular debt fund?
So for this particular fund, we've taken CRISIL long duration benchmark. They've been known to have their benchmarks in the past, and they're backdated data. Also, if you see, the model shows that if you stay invested for a longer period of time, 10 years in this benchmark, then on a CAGR basis, you get a 8% plus is somewhere the return that you have seen in last 10 years about back testing of it. So this benchmark has been there around for a pretty long time, and we are taking this benchmark for the particular fund.
So there's a 7 years tenure, there is a 12 years tenure.
No, there is, the category allows you to be between a 7 and a 12 year.
Okay.
Minimum is 7 years,
Okay.
and higher, on the higher side, because of the security availability, you can go 12 years.
Parting questions to you quickly. So criteria or parameters to be investing in Mirae Asset long duration funds should be duration,
Duration, interest rate is something that you should be looking
Aware of,
at.
okay.
And quality
what's the
portfolio.
coupon rate, if I can just
Sorry?
what should be the coupon rate for this particular investment that one should be expecting?
So the YTM that we are expecting somewhere is around 6.9 to 6.907% is
Sure.
something that we are expecting.
These details would be given in the offer documents already to the investors.
It can only be given after the investment has happened, and
Right.
it will be given out in fact sheet.
In fact sheet.
Yeah.
Okay. All right. So that concludes our insightful discussion in which we covered a range of topics, right from the impact of global factors on domestic interest rate to the potential benefits of long duration funds. Now, by understanding these details, you will be able to make better investment decisions. But as always, it's advisable to consult with a financial advisor to tailor your investment strategies to your specific needs and risk tolerance. Thank you so much, Kruti, for all your valuable advice and insights. And thank you so much to our viewers also. We hope that you found this webinar informative and helpful. Thank you so much for watching. Goodbye.